So gain on sale accounting, that's what we're going to look at here. An example of what happens with a journal entry, balance sheet, income statement, and statement of cash flow. So some assumptions to have here. Let's assume we bought some equipment for $100,000 back in the day. It's depreciated $75,000 up to this point in time, and we're going to turn around and sell it for $75,000. So we'll take a look at what happens. Did we have a gain on sale? Did we have a loss on sale? Right? What's the book value of our equipment? So the gain on the sale formula is going to be the sales price minus the book value. Right? If the sales price is bigger than the book value, we have a gain, which we did in this case. The book value, remember, is just going to be the asset purchase price minus its accumulated depreciation. So in our example, we have a book value of $25,000, right? We bought it for 100, it's depreciated 75, and so we have a book value of 25,000, right? That gives us a gain on sale because remember, first page we said we're selling it for 75,000. Subtract out our book value of 25,000, and that gives us a $50,000 gain. And that's important. Uncle Sam wants to know about that because we're going to have to pay taxes on any gains. Conversely, if we had a loss, we get, a write-off on that loss. In this case, however, we do have a gain. So next thing I'm going to show you is what does the accounting look like for this, right? What would our journal entry be in this case? What are we going to debit? What are we going to credit? To get rid of this equipment, take it off of our books, and record the cash that we got. So we're going to debit cash $75,000, right? Because we got cash. We sold it for $75,000. Our cash goes up. Cash is an asset, so we debit cash $75,000. To get rid of the accumulated depreciation in the equipment on our books, we've got to do the opposite of what is on the books. So remember, for equipment has a normal debit balance. It's in the ledger for debit balance of 100,000. To get rid of that, we've got to credit it 100,000. Those two will net to zero. Equipment's gone. Accumulated depreciation is a contra asset account, so it has a normal credit balance. To get rid of that $75,000 credit, we're going to debit it. Those two offset to zero. And then we record our gain on sale as a credit because that's a revenue account, right? Gains are credits. And so you can see total debits equal $150,000. Total credits equal $150,000. The journal entry balances and everything looks good here. Next, we'll show you what does the balance sheet look like before and after. So you can see in this case, we have the equipment before. The middle column, right, is showing $100,000 of equipment, minus that accumulated depreciation of $75,000 gave us that book value of $25,000. In this simplified world, right, our total assets are $25,000. We're just focusing on this, right? After the sale, our cash goes from 0 to $75,000 because we just sold it for $75,000. Somebody gave us that cash, right? You can see now the equipment and accumulated depreciation and the book value are 0 because it's no longer in the company. We got to make that 0. Total assets are now $75,000. They've jumped from $25,000 to $75,000. That's that gain of $50,000 we got when we sold it. Next, we'll show you what does the income statement look like. And of course, this will be a very simple example to isolate on the activity of selling this equipment. So the only thing we did was sold this equipment this period. So we have gain on sale of $50,000. That's our entire net income of $50,000, right? That's as simple as we can make this example to illustrate the point. Next section is cash flow, right? So when we're doing the indirect method, we always show cash from the income statement first. That $50,000 is from our income statement here. That's plus $50,000. Now, you're going to subtract out any gains from sale of equipment here so that the net operating cash flow is 0. Why? Because that cash flow that we got, the $75,000, is going to be recorded in the investing section, not up here. Otherwise, we're going to double count. So down below, you can see we've recorded that cash flow we got from selling the equipment. There's our 75,000, right? That's a cash inflow when we sold the equipment. It's a cash flow from investing activities of $75,000. So the total cash flow to the company is positive $75,000, right? The stuff we put on the income statement here had nothing to do with that $75,000. So we subtract that out of operating activity because it's not an operating activity, it's an investing activity. And there's your $75,000 cash flow. And remember, on the balance sheet, this has to reconcile to the balance sheet. So on our simple balance sheet, this does reconcile, right? Because remember, cash went from 0 to $75,000. There it is, right? That change in cash flow is equal to our cash flow statement, which just showed you cash flow overall went up $75,000. Going back to the journal entry, we've accounted for everything, right? There's our increase in cash flows shown on the cash flow statement, $75,000. We wiped out the accumulated depreciation in equipment to zero that out on the balance sheet. The income statement captured the $50,000 gain, right? We had to subtract that out of operating activity on the cash flow statement so we don't double count any cash flow, right? We only got $75,000, not an additional $50,000. That's why we had to reverse that out of the operating section of the cash flow. So that's essentially why you need to, right, subtract gains on sales from the operating section of the cash flow. It's going to be recorded in the investment section of the cash flow statement.